You're on.
All right, so we have a ton of stuff to go over today. I may skip a couple of examples, but they're in your PowerPoint with the answers, so you can go over them yourself. And then if we have time at the end, we can come back and look at them more closely. But since we have so much to get through, I thought that I would do some examples and then we'll skip over and see if we have more time at the end. So we talked about Social Security and federal withholding yesterday. The last mandatory tax that comes out of most employees' checks is Medicare. Medicare is 1.45% on all wages up to 200,000. At 200,000, the employee has to pay the additional Medicare tax on anything over 200,000, which is 0.9%. That is an employee only mandate. It is not required for the employer. The tax for the employer will always be at the 1.45%. So really quickly, here's an example. Elizabeth was paid $3,500 and she had a year-to-date wages of $199,000. And so when we give her this $3,500, we're going to have to pay Medicare the 1.45% on the whole $3,500, but the amount over 200,000, we're going to have to pay the additional Medicare on also. So if we take the 3,500 multiplied by 1.45%, we get 50.75 for the regular Medicare that has to be paid on the 3,500. And then the portion that went over 200,000 was 2,500. And so if we take the 2,500 and multiply by the additional Medicare amount, that's 0.9%, we get an additional $22.50. So if we add those two together, we get that $73.25 total must be withheld in Medicare tax. But the employer's share of Medicare tax would only be the 50.75. They would not have to pay that additional 0.9%. So voluntary deductions, lots of things can be voluntary deductions, union dues, charitable contributions, things like that. For charitable contributions, the employer should provide the employee with a statement, whether it's on a pay stub or a W-2, to show how much they have contributed to a charitable contributions. That way the employee can record that on their personal income tax return to get the benefit of that. So for example, Leah has $50 withheld from each monthly paycheck in 2020 for United Way. Her employer is required to report the amount on her pay stub or form W-2 in box 14 for her to claim the charitable deduction. And she also needs a pledge card or other document from United Way showing that she did make that contribution so that she can, again, claim it on her tax return. So the total tax liability for an employer is important when you're making federal 941 deposits to make sure that you're depositing those on a timely schedule based off of your liability. So the total liability for the employer comes from federal income tax withheld from the employees, as well as Social Security withheld from the employees, and Medicare held from the employees, as well as the employer's share of both Social Security and Medicare tax. So it's not just what you're withholding from the employee, it's combined with the employer's share as well. Gross ups. Gross ups can be fun, as we all know, and I will tell you, gross ups were a big part of the CPP when I took it. I don't know if it was just coincidence or what, but I did happen to have several gross up calculations that I had to do when I took the test. So these next few slides, again, I'm not going to go over every single one of the examples just due to time, but if you have time to come back and do them, or if you're using PayTrain as a supplemental a guide for you to help study for the CPP, I would recommend taking a good look at the gross up calculation.
And I want to say, I'm going to interrupt you real quick, that the gross up calculation is one of the most magical calculations ever. We use it all the time. And if you can get your hands around it, it is purely magical to figure things out.
It is. So the basic formula is the gross amount of earnings is going to be equal to the desired net pay divided by 100% minus the total percent of all tax paid. So first of all, we're going to calculate the total percentage of all taxes paid. This includes everything that you're going to be grossing up for. Now, a lot of people, when they gross up for certain things, they don't gross it up for every single tax. In the CPP exam, I had examples of both, where they only grossed it up for certain taxes like FICA and Medicare. Others, they grossed it up for everything, federal withholding, state withholding, and even some local withholding. So make sure that you know what they want it grossed up for before you go and do your calculations. So step one is to calculate the percentage of all taxes paid. This could include everything from federal withholding, Social Security, Medicare, state withholding, local withholding, or just be certain ones of those. Then you're going to subtract that percentage from 100%. And that's what we're going to end up dividing the desired net pay by to get the gross up amount. And then it's always a good idea to check your work. So let's look at a specific example. So Generosity Inc. wants to give an employee, and I can't see the top of my screen because there's a little thing in front of it from Zoom. So I don't actually know what that says.
Do you want me to read it?
Yes, please.
Generosity Inc. wants to give employee Linda a $6,000 year-end bonus. To ensure that Linda receives the net of $6,000, Generosity agrees to pay her federal income and state income taxes and her Social Security and Medicare taxes on the bonus. The bonus is supplemental wages for Linda at the time Linda's bonus is paid. Her year-to-date wages are $45,500.
Perfect. Thank you, Manon. So the reason it's important that they tell you that her year-to-date wages are $45,500 is so that we know how much Social Security, how much Medicare she's having to pay, and all of those things. They tell us it's supplemental wages to give us a hint as to what percent to use for her federal withholding. So I tried to make this as clear as I could to help you follow through on the example. So this is how we would calculate the gross up for this bonus. And they tell you that the state supplemental wage withholding rate for her state is 3.5%. So that's what we're going to use for for the state. So step one, we're going to find the percent of all tax paid. We're going to use 22% for federal withholding, 3.5% for state withholding, 6.2% for Social Security, and 1.45% for Medicare. If we add all of those percents up, we get 33.15%. Step two is we're going to take that percent, we're going to subtract from 100. So 100 minus 33.15 is 66.85. And then we're going to enter that into our formula. And remember, our formula is our gross amount of earnings is going to be equal to the desired net payment divided by 100% minus the percent of all the tax paid. So our gross amount of earnings is going to be equal to $6,000 because that's the desired amount that she needs in her pocket. And we're going to divide by the 66.85% because that's 100% minus the total percent of the tax. And we get $8,975.32.
So Melissa, you might want to remind, like me, how to convert a percent to a decimal to make
Good
it
idea.
easy. Yeah.
So converting a percent to a decimal, you move the decimal place 2 decimal places to the left if you're going from a percent to a rate, and 2 decimal places to the right if you're going the other direction. So 100% as a rate is always 1. So the decimal on 100 sits at the end. Turn that into a rate, you would move it 2 decimal places to the left, which puts it right after the 1. So yes, that is a very good point. And yes, you will need to know how to convert decimals to percent because they only allow you on the CPP exam to use very, very basic calculators. And I don't think they allow you to have a percent button on your calculator.
Yeah, and I do it even simpler than that. I make everything like numbers, 100 minus 66.85. And then I make the 66.85 a decimal. So then I just get the total amount, the $20,000 divided by 0.6685, and it gives me the number.
Mhm.
Because it's easy to get wrapped around decimals and percentages for
Yes.
CPAs. Sorry, not you, but just CPAs.
No, things that I don't think about. I come from a different world, so
You do.
I do. So yes, it
Sixth
is
grade.
important.
I just need sixth grade math.
I'm
Sorry.
used to a little higher math. So the last step is just to check your work. So we're going to take our 22%, multiply by the answer that we got, which was $8,975.32, multiply by 22%, and we get $1,974.57 for federal withholding. Do the same for state withholding, and we get 314.14. Social Security, we get 556.47. Medicare, 130.14. And if we take our $8,975.32 and subtract all those things from it, we do end up with $6,000 even. As Angela said, this formula is super powerful. We use it a lot, but you do have to be a little bit careful to make sure that you're only including the taxes that you want it grossed up for in the calculation. So I say that because on the CPP, like I said, they do throw things at you where you will only have to gross it up for certain taxes and not all taxes. So just be a little careful when you're going through the examples on those. Questions on that?
Thank you.
Mhm. So this is one of those examples that I'm going to skip just because of time, but this is a really good one for you guys to come back and look. It has all the steps laid out for you, but this is an example of grossing up when you're crossing that Social Security wage base. And the reason this gets complicated is because once you cross that wage base, you don't have any more Social Security tax that you have to keep in your gross up calculation. So, and I guarantee you, if you have, they will throw a question like this at you on the CPP exam. So if we have time at the end, I'll
It
come
was
back.
on mine.
Huh?
It was on mine.
Yes. Yeah. I'm glad that I'm not the only one that had those because they absolutely had them. And the other thing that I want to remind you guys is that the CPP exam is 100% multiple choice. So you can, make sure that you're checking your answers, and it's not going to be where you have to fill in your own answer. You're going to have to pick one of theirs. So if the answer you get at the end of your calculation obviously doesn't match with one of theirs, you might need to revisit and see what you did wrong. So another one that we talk about often, or that I had on my CPP exam, is grossing up with a 401k, which the reason this also gets confusing is because 401k is a traditional 401k deferral is not taxable for federal and state income tax. It is taxable for Social Security and Medicare, but not for federal and state. So
I agree 100%. This is absolutely on the test.
yes. So
Do
again,
it, do it.
put a star
Practice.
by this one for sure, and make sure that you feel comfortable with this one. And then, like I say, PayTrain is an amazing resource. If you guys have that, I would recommend ordering it. It's an amazing resource to test yourself on. Also, just Googling examples of grossing up with 401k just to try and get some practice, because they do this too on the test for sure. Okay. So I'm going to skip that one again. We'll come back to it at the end if we have time, but I want to make sure we get through garnishments. Same thing with that one. Okay, so pop quiz: when calculating a gross up for an employee working in a state with no income tax and year-to-date wages of $50,000, the employee's desired net payment of $5,000 is divided by 100 less the, so here we're trying to figure out which taxes we're going to subtract from 100 when doing our formula for gross up. So would it be A, only federal income tax, B, Medicare only, C, Social Security and Medicare only, or D, federal, Social Security and Medicare?
And remember, yep, thank you for typing your answers into the chat.
A, B, C, D, what do you think?
E.
D, it is federal income tax, social security, and Medicare. They didn't have any state, so. Very good. All right. So state income tax and multi-state income, this is always fun. How do you determine who is a resident and whether they should follow the laws of the state of residence or the laws of the state in which the services are performed? So the basic rule of thumb is the default rule of the state income tax withholding that can be used as a starting point is to withhold income tax for the state in which the services are performed. So that's the easiest, most common thing. If the employee lives in that same state, it's super convenient because then you don't have to worry about anything fancy. There are some states that have reciprocal agreements. A lot of states over on the East Coast have reciprocal agreements among them for people that commute between the states to work. So that's something that you have to keep in mind. Nexus is literally means business connection. So nexus is established by having a business presence in a state. And so if you have nexus in a state, then you are subject to withholding laws in that state. So basic rule of thumb, use the state that the employee is actually performing the services in if it's possible. And if not, then we can go to some other rules. So again, withholding rule number 1 says first we're going to try to withhold in the state of residency of the employee. If we can't withhold in the state of residency of the employee because, for example, they aren't working in that state, then we can go to number 2, which is reciprocity. If there's a reciprocity agreement in place among the states, then you can use that reciprocity. Be careful on that one, as you usually have to get some sort of form from your employees stating that they want to utilize the reciprocal agreement between the 2 states. Rule number 3, if an employee is resident of one state but performs services in another and there is not a reciprocal agreement, then you must consider the laws of both states. So be a little careful. So in this example, a California resident works exclusively in Arizona for 6 months. And if the employee has nexus with California, then Arizona withholding is required because the 60-day threshold is exceeded, and every state has a different threshold. Every state has different requirements. So make sure that we're looking at those. California withholding is required with a credit for income tax withheld in the work state. So for example, if you're working in Arizona and you're withholding 3% in Arizona, but you live in California, and the state rate is 5%, California wants the difference. They want their 2%. So have to be a little careful and make sure that you're taking all of those things into account. Railroad employers are subject to a different and distinct system of employment taxes that are very similar to ours, but they are specific to railroad. So it's the same for FICA, it's same idea for FICA and for FUTA, except that there's a railroad division of these taxes as well that must be withheld for businesses in that industry. So let's talk about some involuntary deductions that are not necessarily taxes, withholding orders, child support orders, things like that. So withholding orders, such as garnishments or child supports or anything like that, as the employer, you are required to withhold once you receive the order. You do have to be careful with state laws versus federal laws, making sure that you're following all of those things. As the employer, you must make sure that you tell the employee about the order and make sure that they have received notice so that they know that their wages are going to be garnished and that they can fight the order if they think it's not correct. The employer must also tell the employee how the order will affect their wages and their net pay. The employer must determine whether the amount of the order exceeds the amount allowed by the Fed or by the state law. If there's multiple orders in place, the employer must also determine which one was a higher priority. They must be able to calculate the employee's disposable earnings to be able to allocate between multiple orders. and they must contact legal counsel to review an order and any outstanding questions if they have any. So child support orders, under the CCPA, which is the Consumer Credit Protection Act, 50% of the employee's disposable earnings can be withheld for child support if the employee is supporting another spouse or family. 60% if the employee is not supporting another spouse or dependent child. These amounts increase by 5% each if the employee is in arrears by at least 12 weeks, and the child support order should say that. I say all of this, but there are state laws that may or may not make these things true. So if the state doesn't have their own laws or doesn't have more strict laws than these, then you can follow these. Many states have more strict laws that say you can't withhold quite as high of percentages as these laws state. So I want to be a little careful on that one. So an employee who is not supporting another family has a semi-monthly disposable earning of $1,200 and is more than 12 weeks in arrears on their child support payment. So the question is, calculate the max amount that can be deducted from the employee's pay. So I'm going to jump back one slide really quick and just remind you of the percentages: 50, 60, 55, and 65. And again, this guy is earning $1,200 in disposable earnings, and he is more than 12 weeks in arrears, and he is not supporting another family. So how much could be withheld?
Managed, did I get it wrong? Is it 55%?
65.
65.
It is 65%, and 65% of 1,200 is 780. So child support orders, when the order takes effect, again, this is one of those big things you have to be careful of with state laws. Colorado recently changed their law that said, you know, you used to have to start withholding immediately, and now there's some different laws that you're not necessarily starting to withhold immediately. So you just want to make sure that you keep up with your state and make sure that you're following the laws of your state. You can, as an employer, you can combine several employees and send one check to the agency as long as they're all going to the same place. You are allowed to charge an administrative fee per federal law for child support orders. That is not always the case per state. So I know that in Colorado, for example, you can charge an administrative fee, but there's a limit on how much you can charge per month to the employee. And I think there's other states that don't allow you to charge an administrative fee at all. So although federal law does allow you to do so, you want to be careful and make sure that whatever state is applicable, that you're following that law.
So I have a question. How does the fee play into the maximum deductible? Do you add that?
Great question. Yes. You cannot. So if you are withholding, say, a $5 fee, that $5 has to be within your 65% in the last example. So that's a great question, Angela. Yes. Okay. So employers there's a penalty if you don't withhold. So you have to be careful, and you have to make sure that when you are withholding, you're withholding the full amount that you're supposed to be withholding. And if you can't withhold the full amount, you have to show why you can't withhold the full amount. So oftentimes we receive IWO changes. So if you receive a change for an income withholding order, then make sure that you apply the changes. It gets more complicated when you have one or more withholding order. So if an employer receives more than one child support withholding order for an employee, state law governs how the orders must be handled. Again, state law governs that. So you need to make sure that you're following the laws of whatever states are applicable. So the first method is to allocate the available wages to each order depending on its percentage in relation to the total amount required to be withheld. And the second method is to allocate the available wages equally to each order until each order is individually complied with or the maximum amount is reached. And that would be allocating equally between the multiple orders. So again, you want to make sure that you're following the laws for your state. So here's an example. Tim's employer receives a child support withholding order requiring $300 to be withheld from Tim's weekly pay. The maximum amount that can be withheld from Tim's pay under federal and state law is $275 and causes Tim to be $25 in arrears each week. Also, the state where Tim works allows employers to withhold a $5 administrative fee each time child support is withheld. Angela, that goes into your question. If Tim's employer wants to collect the administrative fee, it can withhold $270 for the current child support, take the $5 fee from Tim's remaining wages, and increase Tim's weekly arrearages to $30. So that goes into your question about the $5 or the fee, the administrative fee. So another example, this one's about allocating among multiple orders. So Executive Suites Candy receives one child support withholding order for employee George, who works in Indiana, on September 8th, demanding $450 per pay period, and a second order on November 17th in the same year, demanding $300. Executive Suites determines the maximum amount that can be withheld from George's pay under Indiana law is $600. Indiana requires a prorated allocation when the total to be withheld exceeds the maximum amount allowed. Once the second child support order is received, the amount to be withheld for each order is determined as follows. So the total, $450 plus $300, is $750. $450 of that was supposed to go to the first order. $450 out of $750 is 60%. But the max that can be withheld is $600. So 600 times 60% is $360. So $360 is going to go to the first order. The second order is going to have the remaining 40%. So 300 divided by 750 is 40%. And then 600 times 0.4 is 240. So the two amounts together add up to the maximum allowed of 600, and it's allocated by the percentages of how much should have been going to the first order, and what percent should have been going to the first order, and what percent should have been going to the second order if the total amount had been allowed to be taken. Does that make sense? So third example, we're going to assume the same facts as we just talked about, except that George works in Texas. And Texas requires the available wages to be allocated equally until the maximum amount allowed is reached. So once the second child support withholding order is received, the employer then can withhold $300 for each order, taking it up to the maximum of $600. Different methods, different states. Unfortunately, you have to comply and review each state's laws to make sure that you're in compliance. Disposable earnings. I will tell you, I had lots of disposable earnings questions on my CPP exam as well. So disposable earnings are calculated by taking all of your pay and subtracting all deductions required by law. So you want to make sure that you're not deducting things that are not required by law to get your disposable earnings. So make sure, taxes are required by law. So your disposable earnings are going to be all of the earnings minus those things that are required by law, taxes, basically. So in the chart below, the first column lists the type of deductions for Steve's gross earnings, while the second and third shows which amounts are to be deducted to calculate Steve's net pay and disposable pay. So he is making $1,950. He has a 401k deduction of $75. Is 401k required by law? Nope. So it's not going to be in the disposable pay column. It is going to be in the net pay column. A medical FSA, again, not required by law. That's why it's not in the disposable pay column. It is in the net pay column. Federal income tax, required by law. So that is in both. Social Security, Medicare, and state, same thing. So while his net pay in this calculation is $1,481.97. His disposable pay is higher than that because those two deductions, the one for 401k and the one for medical FSA, are not required by law and thus are not deducted when calculating disposable pay. The child support deductions should be calculated on disposable earnings, not on net pay.
I have a question about the FSA. So if he had made a salary reduction request with an FSA,
Mhm.
and you make those annually unless you have a life event,
Mhm.
and then he gets a child support, since he's already made a salary reduction request with an FSA, does that then change the scenario a tad bit?
I do not believe so for child support. It will for federal tax levies and things like that,
Thank you.
unless you know something I don't.
Well, I think I've sort of read something, but it might be the tax levy that I'm thinking of, that if something's in place, like health insurance, et cetera.
See, and for
Then-
federal tax levies, yes, they do come into play, but I didn't think for child support it did.
I'm sure you're correct,
I don't know about that.
and I am not, so, thank you.
Okay, so a national support, I didn't really talk about support orders, sorry. If you get a support order, it requires you as the employer to comply if you offer health insurance to your employees. So if you get a national medical support notice, it requires the employee to, one, forward the order to insurance provider to contact the employee. Nope. Two, do nothing. Employers are not obligated to comply with medical support notices. Nope, that's not it either. Honor the qualified medical child support order or instruct the employee to purchase a separate health insurance policy for the child. So you have to honor it. That's what you have to do. So it's the third one. What time is it? 11:30. Okay, so Terry's employer receives a child support withholding order demand of $700 of Terry's disposable earnings to be withheld each pay period and sent to the state child support enforcement agency. This is if it's biweekly, $350 if the payment is weekly. Got it. The state where Terry works follows federal law in determining the maximum amount that can be withheld for child support. Terry's year-to-date Medicare wages are $50,000. Terry is not late in paying support and is not supporting another spouse or child. So Terry's disposable earnings and the amount to be withheld are, if he's not supporting another family and he's not in arrears, what's the biggest percentage we can take?
$60. Oh, not in arrears. $50.
50.
He's not in arrears and he's not supporting another family.
Oh, $55.
Nope, you were right the first time.
Oh,
It's 50 and 60, and then it goes up 5% if you are in arrears. So 55 and 65. So 60, yeah, you were right. Okay. So we're gonna take his biweekly earnings of $1,600, his federal income tax, all of the taxes we're gonna take out to calculate his disposable earnings. His health insurance, 401k, and charitable contribution are not required by law. Thus, they're not going to come out of his disposable earnings. So to figure out the max amount we could withhold, we're going to take the $1,133.42 and multiply by 0.6 or 60%. And that's the maximum amount that can be withheld for the child support order. They're asking for $700, but 60% is only $680.05. So unfortunately, they're not going to be able to withhold the full amount because it exceeds the 60%. Second example, Ronald's employer receives a newly issued child support order while Ronald's wages are already subject to a federal tax levy under which the employer is currently withholding 45% or $450 of Ronald's disposable earnings every 2 weeks. He gets $1,000 every 2 weeks. The original issue date of the child support order does not predate the federal tax levy. For the purposes of this example, assume that the amount of Ronald's disposable earnings and take-home pay are the same. Ronald is not supporting another spouse or child other than those mentioned in the child support order, and he is not more than 12 weeks in arrears in making child support payments. So his disposable earnings remain $1,000 after the child support withholding order is received, but his employer may deduct only $150 or 15% of Ronald's disposable earnings to satisfy the child support withholding order, because the maximum amount that can be withheld is that 60%. And they're already taking $450 for the previous withholding order that was in place. So 450 plus the 150 gives us the 600. So let's talk about federal tax levies. So first of all, if you failed to pay your taxes, you may get a federal or state tax levy. And those things go to your employer, and they are required by law to withhold from your check. So these are calculated in a little bit different ways. And the notices from the IRS anyways come in the form of Form 668-W, which is a notice of levy on wages. So take-home pay is the amount of the employee's wages that remains after all normal deductions in effect at the time a levy is received have been subtracted from the employee's gross pay. So this is where I think, at least this is where I think those medical or FSA or anything that's in place at the time the levy is received, they get to remain in place before that take-home pay is calculated. So let's look at an example. So Arthur receives $2,400 semi-monthly from his employer. On August 1st, they received a federal tax levy that was being issued against Arthur's wages for $25,000. Arthur claimed married, filing jointly with 3 dependents on Part 3 of the form and gave it to payroll department. As of August 1st, Arthur's year-to-date Medicare wages were $40,000, and he had the following deductions. So these deductions were all in place when the order was received. Taxes, plus he had a Section 401k plan, which was 3% of his salary, and he had some health insurance. His take-home pay, and so I put up there this is the table that the IRS puts out to show how much they get to take home, and the rest is subject to the federal tax levy. So they told us he's semi-monthly and that he's filing jointly with 3 dependents. So if you look at that row in the table, that means that he gets to take home $1,570.84. So if you look at his wages, $2,400, you subtract all of his health insurance, taxes, 401k, you get $526.12 for all of those things, which gives you $1,873.88. He gets to take home, per this table, $1,570.84. Therefore, the difference of those two numbers is $303.04, and that's what they get to take for the federal tax levy. So that's what Angela was talking about. The 401k was already in place when this levy was received, and the health insurance was already in place when this levy was received. So those two things get to stay in place before the take-home pay is taken into account.
So how does this relate to minimum wage?
How does it relate?
Or is that student loans that people have to take minimum wage home in their net pay pocket?
Oh, that's garnishment creditors.
Okay,
Garnishment. Creditor garnishments.
great, we'll get there.
Yep.
Thank you.
So really quickly, I'm not going to go into too much detail, but on a same example, on October 1st, Arthur changes some things. He ups his 401k to 5% instead of 3%, and his health insurance goes up to $55 instead of $45. Those two things happened after this levy was in place, which means that those two things don't get to be taken into account when they're calculating the take-home pay. So in other words, the difference between the $10 difference in his health insurance and the difference between the 3 and 5% of his 401k, they have to be ignored when doing the calculation. So again, I would put a star on that one and look at that one, because I know that these types of things come up on the CPP. An employee earns $2,267.52 semi-monthly and has a creditor garnishment of $30 when a federal tax levy of $10,000 is received. The IRS exempts $695.84 per pay period from the levy. So that's what they get to take home. The employee's combined federal income tax, Social Security, and Medicare tax is $672.32. So we're trying to figure out how much should be deducted for the levy. So if we take the $2,267.52, we subtract out the creditor garnishment because it was in place when the federal tax levy was received. Also subtract out our taxes of $672.32. And he gets to take home $695.84. So the amount that should be subject to garnishment is $869.36.
That's
Sorry.
a lot of money.
It is a lot of money. Sorry, I'm going fast. These 45-minute sessions go super fast, which I love, but lots of information. So real quick, creditor garnishments, the most common ones are, they generally take 25% of disposable earnings. And this is what Angela was talking about, where it has to be, the employee has to be able to take home 30 times the federal minimum wage or state minimum wage, whichever is higher. And so you can't take more than, you have to allow them to take home at least that much. So Michelle's disposable earnings for a week are $245 when her employer receives a garnishment order on January 9th, requiring that $300 to be withheld. Under federal minimum wage, the maximum amount of disposable earnings that can be garnished is determined as follows. So a creditor garnishment, like I said, normally it's 25% of disposable earnings. So if we take 25% of $245, we get $61.25. If we take 30 times the federal minimum wage of $7.25, we get $217.50. So that's the minimum amount she has to be able to take home. If we withheld the full $61.25 or the full 25%, she would not take home the $217.50. So we can only take the difference of that. So the 245 minus the 217.50 gives us 27.50 is what is going to be sent to the garnishment company for that particular week or pay period. And the garnishment orders show the calculations, the minimum wage times 30, they have those calculations on them. Josephine's disposable earnings for a semi-monthly pay period are $550. She receives a garnishment order on January 12th, requiring $150 to be withheld. The maximum amount that can be withheld for this one is going to be, if we did 25% of $550, we would get $137.50. If we did federal minimum wage of $7.25 times 30, we would get $217.50. Oh, semi-monthly, sorry. So $7.25 times 60. Is it 60 or 75? Gosh, I would have to look at the table again.
I think
Huh?
it's 75.
Isn't? I would have to look at the table again. But anyways, you can't withhold the whole percentage. You have to only do the 78.75 to, that's subject to garnishment because they have to have that minimum take home pay. Real quick, other types of garnishments: bankruptcy, federal loans, federal agency garnishments. They all have their own specific. Federal loans are usually 15% of the employee's disposable earnings. The recent law due to COVID, those have all been stopped. I don't think they've been put back in place yet. Like I said, there's a ton of examples on here and in the PowerPoint, there's a ton of information that Manon said she sent out the updated PowerPoint to you guys. So make sure you look at it. It's already 11:45. Time flies when you're having fun. Like I say, take the time to look at those examples and go through them. And I'm happy to answer questions. If you guys have questions, just holler at me. I'm happy to go through the examples in more detail with you if you would like.
Stick your email in the chat or mine, and if people have questions.
I don't know how to chat. Oh, here we go.
All right, have a great weekend, everybody. And next weekend, or next week, we have Rebecca Kilpatrick on fringe benefits. Super excited. We'll miss you, Melissa.
I'm so excited to listening to someone else chat for a while.
Oh, so after today, I will send out the recordings from all 3 sessions this week. I will send out a quiz, like a take-home test that you're welcome to complete to test your skill. And for those of you who are getting the RCH credits, I will also send out your certifications for your 3 credits from this week.
Thanks, Manon.
Thank you.
Thanks.
you.
Happy Friday, everyone.
Happy Friday. Thank you.